Welcome to the Deep Dive. Today, we're digging into a really fascinating investment story. It's about a fund that's managed to consistently beat the market and by quite a margin.
Yeah, it really stands out.
We want to unpack how they did it, look at their unique strategies, and maybe see what insights that offers, for your own approach.
Exactly. So for this, we've looked at the Capital Alphabet Fund's fact sheet
Yep.
and their annual letters 2022, 2023, and the latest for 2024.
Yeah.
And the mission, really, is to pull out the key ideas behind how they achieve this outperformance. What makes them different, and what could that mean for you?
Right. Let's jump straight into the performance then, because it's pretty eye-popping. Since they launched June 2022, Capital Alphabet has a cumulative return of 133.35%. This is up to Q2 2025.
Wow.
Compare that to the S&P 500 over the same time, 55.95%.
Huge difference.
It really is. Think about it like this. $100,000 in the fund becomes over $233,000 in the index. We're like $156,000.
That really puts it in perspective. And what's key is their core objective, what they call their North Star. It's not just about going up with the market.
Oh, interesting. How so?
Well, they're focused on maximizing value long-term by beating the benchmark. And critically, they actually aim to do better when markets are flat or even falling.
Okay, so like preserving capital.
Exactly. They actually say, if they're down 15% when the average market drops 30%, that's a better result for them than just rising 20% with everyone else. It's about relative performance, especially downside protection.
That definitely shifts the perspective. So how do they actually, do that? What are they investing in?
It comes down to their focus on high-quality companies. They have specific criteria.
Like what?
They want businesses with substantial economic moats, so strong competitive advantages. They look for a high return on capital employed, meaning the company uses its money well.
Makes sense.
And a huge margin of safety, buying below what they think it's really worth. Plus, and this is important, run by trusted management.
So very disciplined. Does that lead to a particular style?
Definitely. They live by two rules. Rule number one.
Let me guess. Never lose money.
You got it. And rule number two is basically only make really obvious bets that you think will beat the index long term, and never forget rule number one.
Right. Stick to the basics.
And because of that strictness, it leads to a very concentrated portfolio, usually just 5 to 10 stocks.
Only 5 to 10. That's quite focused.
It is. It's about high conviction in a few ideas, not spreading bets thinly.
Okay, so where have they found these no-brainer high conviction bets? Let's get into the specifics.
Right. Their biggest bucket is what they call undervalued securities. A key example was back in 2022. Remember when the Chinese stock market really tanked?
Yeah, it hit some major lows.
Well, they saw an opportunity. They invested significantly in Tencent and Alibaba. And Naspers, which owns a huge chunk of Tencent, was a real rock star for them.
Why Naspers specifically?
It was trading way below the value of just its Tencent shares, maybe a 30% discount, and isn't buying back its own stock. That combination was powerful, contributed about 32.75% attribution to their gains at one point.
Okay, so a savvy international play. What about more recently in the U.S.?
Good question. As things shifted, so did they. In 2023, 2024, Meta Platforms became a star performer. They got in around $100 a share.
Wow, good timing.
And Bank of America also did well for them. But interestingly, in 2024, they actually reduced exposure to some of those big, magnificent 7 stocks like Meta.
Why is that? Valuations.
Exactly. They felt valuations got too high.
Yeah.
Shows discipline, right? Not just chasing momentum. They also have this smaller category called workouts.
Workout.
Yeah, these are situations depending on like corporate actions, mergers, liquidations. They mentioned energy in the oil sector as an example, but the manager is refreshingly honest that these don't always pan out.
That honesty is good to hear. Speaking of which, how much conviction does the manager personally have? Is their own money in this?
Absolutely. That's a big point they make. The manager has over $1 million of their own capital invested.
Over $1 million. Okay.
And they state the intention is to hold it for 25 years. So, they're truly eating their own cooking. Their interests are aligned with the investors.
How does that work structurally for investors?
They use separately managed accounts, SMAs.
Yeah.
So you, the client, have direct ownership and transparency. The minimum is $25,000, but they suggest $100,000 is better to get the full effect.
That alignment and transparency is definitely compelling. And you mentioned the manager's reflections. They seem quite candid.
Very much so. They openly admit, personal limitations. Like never being able to bottom tick a purchase, basically, never buying at the absolute lowest price,
Yeah.
or finding it hard to time selling perfectly.
That kind of humility is rare.
It is, and it connects to a really powerful story the manager shares from their own experience back in 2003.
Oh, yeah. What happened?
They made a $5,000 investment in some land near a developing IT hub, just
Yeah.
held on to it through ups, downs, political changes, everything. It turned into a 50-bagger, grew 50 times the initial investment.
Wow. 50 times.
Yeah. The point wasn't just the return, but the power of long-term compounding, and crucially, staying invested through all the noise. It's a lesson that really resonates.
Absolutely. So, recapping this deep dive, we've seen a strategy that's disciplined, clearly value-oriented, focused on the long term, incredibly transparent,
And backed by serious personal conviction for the manager.
leading to, well, pretty remarkable outperformance so far.
So, considering this mix, the tough analysis, the concentrated bets, the manager truly having skin in the game, perhaps the final thought for you is, how might seeing this approach influence your own perspective? How you sift through market noise and think about your own long-term investment choices?